Hello and welcome to this session on GrayMatter's Finance Analytics. In today's session, we'll focus on a specific business scenario which depicts how finance analytics can be used to make critical business decisions, or let's say critical financial decisions for your organization. So here we go. John is a CFO of a global conglomerate which is facing multiple challenges. The organization is witnessing a decrease in sales over the past couple of quarters. Management team is struggling to address this, as well as the need, of course, to have a good profitability on the shareholders' investments. John is faced with these challenges, and presently he has logged into the CFO overview dashboard of the Finance Analytics product to have a look at how he can uncover the root cause behind the problems and probably figure out a way to solve these challenges that he is facing. So here we are. The CFO overview gives you a cockpit view to the CFO in terms of the critical financial metrics for the organization. Um, so John has come with a specific problem, and he, of course, wants to look at which are the lines of businesses which have caused the major degrowth in business. So you can clearly see manufacturing and oil and gas in red. Now these business lines instantly, like you can figure out by the width of the boxes here relative to the other boxes for the other business lines. These two business lines are major contributors, revenue contributors to the organization. Now, manufacturing and oil and gas are traditionally asset intensive, or let me say capital investment intensive businesses. So the changing times and increasing automation, now the businesses demand more capital investment to retain and grow its market share. So probably that could be a trick, or that could be a clue behind the dipping revenues of these two areas. Probably competitors are piling in more capital investments and grabbing more of the market share, and probably the business here, John's organization, is not able to keep pace. So John kept that at the back of his mind and quickly navigated uh, to the to the DuPont analysis dashboard to see to have a little bit more insight into what is the right direction. So he notices that return on equity has also been dipping compared to previous periods. And so the concern on about return on shareholders' investment was indeed justified. To compound problems, he also found that the net profit margin has been dipping over the periods, right? So John had a couple of quick indicators here in terms of the return on equity and the net profit margin. And so he thought of quickly going back to the CFO overview and trying to correlate. So basically, return on equity is driven by how healthy your return on assets are, how healthy your net profit margin is, and how leveraged you are as a business. Now, John glanced at the leverage number on the CFO overview and noticed this neatly stacked figure here, which says that the debt equity ratio for the organization is 0.5 versus an industry average of 1.0. So John thought that going back to the equation, he's had a look at return on equity, return on assets, and leverage. Probably the one thing he missed out on the DuPont chart was the return on. Navigates back to the DuPont chart, and he sees the return on assets, although has been healthy and it's been increasing over time. So John started pondering, and he thought that probably all this links back to the observation that, or to the hypothesis that businesses like manufacturing and oil and gas need capital investments, and probably asset acquisition was the name of the game as far as these two business lines were concerned. So John started pondering, and he realized that these businesses could clearly use funds to acquire assets, and given that the leverage of the organization is fairly below the industry average, there's still space or scope for greater leverage. So they could basically they could basically increase their leverage and use these funds to acquire assets for the manufacturing and the oil and gas lines of businesses. It was almost certain that the fresh capital investments would also drive the revenues northward over a period of time. A significant increase in sales would ensure that although assets are also increasing, return on assets would remain the same or go up in spite of the asset acquisition. With increasing sales, of course, the net profit margin is also likely to go up over time. Most importantly, if you take a step back and go back to the previous chart, the leverage will go up, right? The leverage would go up would mean that if you go back to the equation on return on equity, which is product of return on asset, net profit margin, and leverage going up significantly, net profit margin and return on assets also going up over the medium period of time, uh, would definitely result in a situation that the return on equity goes up. So what happens here is that you end up investing in these businesses. These are the major contributors to the revenue of the conglomerate. Hence, you get once the sales of these businesses go up as a response to the fresh investments, the sales of the conglomerate goes up. Sales of the conglomerate goes up. Probably your quarterly numbers is better, and hence one part of the problem is addressed. The other part of the problem, as far as return on equity is concerned, also goes up, as we discussed just now, because of the healthy improvement in, let's say, the increase in leverage, net profit margin, and return on assets. John was happy with the solution surfacing through the insightful dashboards in front of him. He had to raise money through debts and make capital investments in the key business lines of manufacturing and oil and gas, drive the sales up, and have a happy return to talk to the shareholders about. Thank you. This is all I had for this session. Thank you for joining.